So inflation is here. We all know it. But how do you keep your practice out in front of it so that you can stay competitive? And that's what I'm going to talk about in this week's tip. So you may or may not be up on inflation numbers, but you've probably felt it. Maybe you felt it at the grocery store or at the gas pump. And keep in mind, if you're feeling it, so are your staff. But what are the official numbers right now? Well, right now, the year-over-year inflation for September of 2021 is 5.39%. 5.39%. May not seem like that big of a deal. In years past, inflation would run at 2 or 3%, and we'd advise clients to raise their fees or to account for it. But, if they didn't, it wasn't that big of a deal. 5.39% is a bit of a bigger deal. How does that break down in actual numbers? Well, think about it. What is inflation? Basically, it's a loss of purchasing power of your currency units. If you're a U.S. citizen, you're using dollars, right? So it's a loss of purchasing power. So how does that percentage, that 5.39% percentage, translate into a loss of purchasing power? And I promise you this is not going to be a boring economics lesson. I'm just going to do this real quick, but it's important to know. Well, if you had $1 in September of last year, that dollar that you kept for the year now buys 95 cents worth of goods, all right? 95 cents worth of goods. Or what you want to buy that you used to be able to buy for $1 now costs you $1.05. So if I had something that was $1 in September of last year, it now costs me $1.05. Now, not a big deal when you're thinking about $1. Translate that into $100,000. I had $100,000 in my bank account. What I want this year that cost me $100 last year might cost me $105,000. Might even cost me more with some of the stuff that's going on right now with supply chain disruptions. But essentially, that's what you're looking at with inflation. And if you're feeling it, so is your team. How might you be feeling it in your dental practice? Well, you might be feeling it in higher energy costs, higher insurance costs, meaning health insurance, things of that nature. Maybe supplies have gone up a bit, and you've most likely felt it a lot with labor, with staff, okay? And it makes sense if you think about it with your staff. Why? Well, number one, with your staff or staff that you're hiring, number one, it's costing them more to live. If you take that 5.39% number and you break it down a little further, you'll find that certain categories are higher than others. For instance, energy costs are up 25%. We have that 5.39% overall. Energy, gas, fuel to heat your home. Well, it's costing your employees more to get to work, more for their electric bill, more to heat their home, and more for food. Something's got to give, right? So your current staff might be looking for raises, and definitely the people that you're trying to hire are looking for more money. I'm in the middle of, right now while I'm filming this, obviously not right this second, but it's happening this weekend, I'm in the middle of the MGE Financial Planning and Profitability Seminar, and I usually like to survey our clients and see what they're paying for things. So I asked, what's the going rate for a hygienist right now? One doctor, $52 an hour, another $46 an hour. That wasn't what they were paying in 2019. That is a drastic increase, a heck of a lot more than 5.39%. So labor costs have gone up because it's costing the people who are working for you more to live. Now, on top of that, and we've talked about this on our podcast and in prior videos, the job situation right now is a little bit weird. As of January of this year, 2021, there were 8 million job openings in the United States. Okay? As of July, there were 11 million job openings. There was 0.8 people looking for work for every job that was available. So there were less people than jobs, all right? So that's a very competitive market, all right? So how is that translated into last month, August? These are always lagging indicators. In August, that 11 million number went down to 10.4 million. Okay, that sounds good when you don't think about the fact that it was 8 million in January. And to give you a little bit of a deeper dive into this, you may or may not have heard of the National Federation of Independent Businesses. It's an organization that surveys small business owners. Well, I've been tracking this for quite a while, especially since the pandemic, to see how has it affected small businesses. I'm going to throw a couple graphs up on the screen and narrate this for you so you can see. So let's look at this first graph. This is, can small businesses hire enough workers? This is the percentage of businesses that responded to this survey with at least one unfilled opening. So they had a position they need somebody for that they can't fill. Now look at where this goes. This is now at or approaching 50%. This graph goes back to 2010, by the way. This is the highest it has been in 11 years. And then to look at the next graph. This is our small businesses hiring workers. This is the net change in number of employees. Have they added employees or lost employees? We'll look at the last 1, 2, 3 months. They actually are below zero. They have lost more employees than they have added. They're at a net loss. So we have more people looking to hire people, less people than there are jobs, and it's hurting small business because they have positions that are going unfilled. What that means, it's like supply and demand. When there is less of something, the price is going to go up. When there's more of something, the price is going to go down. Well, right now there's less in the way of employees, and on top of that, these employees are in an inflationary environment. So what should you do about this right now, or what can you do? Well, to put it simply, dental offices operate best when certain categories of overhead fit within a certain percentage. For example, you never want your payroll, excluding the doctor and associates, to exceed 22.5%. So for all your employees, with the exception of you and your associate doctor, you don't want to pay more than 22.5% of revenues, including payroll tax. All right? So let's say you're doing $100,000 a month and your payroll is $22,500. You're right at that 22%, 22.5% number. And then all of a sudden, you give everybody a 5% raise. Someone who's making $20, you give an extra dollar. In some cases, you've probably given out more. Well, you've raised your payroll percent by 5%. Instead of $22,500, it's now $23,650. All right. To make that percentage work as a percentage of overhead, your revenues have to go up to $105,000 from $100,000. They have to also go up by 5% without increasing costs. So essentially, the way out of this, if your marketing is going up and your staff costs are going up and your insurance, all these costs are going up, is you have to increase revenues without increasing costs. Now, maybe there are things I don't know, but the only thing I'm aware of, I mean, of course, you can cut costs and do things more efficiently, but one of the ways to do this, number one, is increase your case acceptance. All right, so you could do things like the MGE communication and sales seminars. But another way to increase revenues without increasing costs is you need to raise your fees. Now, again, going back to the prior years, years and years and years back with inflation, we'd often recommend to our clients, look at the end of the year, start gearing up to raise your fees, with whatever the inflation rate's been, 2% or whatever, in the next year. Some folks would do it and some folks wouldn't. It would become a problem if they hadn't done it for a while, and then they'd have to do this massive fee increase, which they would have to stage over time. This is not then. This is not then. As a matter of fact, if you talk to Sabri, our Deputy Chief Operating Officer, who you've seen in many of our tips, Sabri is telling folks to raise their fees by 10%. Now, some people find that a bit too much. That's a lot to raise your fees. Well, then if it's difficult for you to think with that, stage it over time. Do 3%, 1 month, and then a couple months later 3%, and a couple months later 3%. But you're going to have to pay attention to these things because you're going to end up in a situation, otherwise the only place for this money to come from as your costs go up is from you, and then you're going to start to, that's me, sorry, you're going to start to have problems. So you want to make sure that you raise your fees. You want to definitely raise your fees. If you have questions about this, we can definitely help you. But then that begs the next question, and this is something that just came up during this seminar that I'm in the middle of doing, or I was lecturing at yesterday. What if you're participating in various insurance plans? What then? Well, what are they doing? Well, here's where it gets funny. We don't have official statistics on this because it's kind of just happening now. But anecdotal evidence from talking to newer clients is that insurance companies are trying to lower reimbursement for participating dentists. So we have an inflationary environment, your costs are going up, and here comes the insurance company going, oh, we're going to lower your reimbursement for a crown. You're real nice guys, right? So if you raise your fees, but 80% of your practice is PPO, all you're doing is really penalizing your fee-for-service patients. So whether you like it or not, I'm going to say it, you need to get out of the PPOs. You need to get out of the PPOs. Now, a couple statistics I'll give to you on this, all right? When I survey newer clients, when I'm doing an MGE communication and sales seminar, which for many of our clients is their first or second service, I'll ask, if you were involved in a plan and you were to drop that plan, what percentage of these patients do you think are going to leave? Here's the answers I normally get. 50%, 80%, not true. We've studied this, we've looked at this, the average is around 30%. Okay, why don't more people drop them then? Because they're scared. And I'm not saying that in a negative way, because obviously I would be scared too. I don't want to throw away my business. But you can. We have clients doing it all the time. And how does this translate into real numbers? Number one, if you raise your fees, you could charge what you want, all right? Number two, when you start dropping these, let's take an example of, let's say you have three patients rather, and they all need a crown. And your fee reimbursement, or your plan reimbursement for this crown rather, is $800. It'll be lower soon. Leave the insurance company some time. It's $800 a crown. So you have three patients, they all need a crown. If you do all three of those crowns, it's $2,400. But let's say you go, you know what, I'm done with this plan. And one of these patients says, doctor, if you're out of the plan, I have to leave. So you're left with two. Let's say your full fee is $1,400. These are real numbers that clients have given me. So your full fee is $1,400, the plan fee is $800, probably less soon. You drop the plan. One of the three patients leave, which is higher than 30%, but just for our little example, let's do this math. If you did all three crowns in the plan, it's $2,400. If one leaves and you do them both at full fee, that's $2,800. Not only that, you have lowered costs. You've lowered labor costs, material costs, lab fees, etc., and you're getting paid what you're actually worth. It's not impossible. You can absolutely get out of plans. We see our clients do it all the time. I know it can be scary. We can definitely help you with it. Now, if you want to see the impact of some of these plans in your practice, like you want to do a little bit of homework yourself, here's something else you can do. I've done a video about this before. We have a tool called the Insurance Plan Analyzer. Okay, I've got a link to it up here that you can click to the video, or there's also a link in the description below that you can click that'll bring you to the web page. What the Insurance Plan Analyzer does, I'm not going to re-explain what the other video explains, but essentially you can take any plan that you currently take, you plug in your full fee and your plan fee for a blend of different types of procedures, and it will tell you, based on our averages of the types of procedures that are normally performed in a dental practice, how much you are losing in a given year. Now the cooler part of that, because that's kind of depressing, right? How much am I losing? The cooler part of that is at the bottom, it tells you if you were to drop the plan and you lost, let's say, 30% of the patients in that plan, how many fee-for-service new patients you would need to replace those patients. All right? And if you lost 50%, how many fee-for-service patients you would need to replace those patients, and so on. Now, here's where this gets super funny. In every plan I've run through the Plan Analyzer, every single plan, if you lost 30% of the patients from that plan, you would need negative new patients to keep your revenues the same. I'll say that again. In other words, if, let's say 100% of your practice was PPO and 30% left, all right, and you were left with 70% of your practice, in most cases, with most plans, I'm not saying all, and this doesn't apply to HMOs, just PPOs, you would need 0 new patients to make the same amount of revenue. It's a bit silly. But anyway, you can check it out. The link is below. Now, as far as setting your fees, and if you want to make sure your fees are competitive or right, you can always go ahead and grab something like the Wasserman Guide. We'll put a link in the description. I'm a bit old school. I like it. I've used it for years. I'm sure there are other services or companies that do this, which give you a fee by zip code in a percentile type fashion. In other words, you look for a zip code by a certain CDT code, and it'll tell you this fee is in the 40th percentile, this fee is in the 50th percentile, meaning if you're in the 50th percentile, that means half the doctors are charging left and half are charging more. All right? I like the 60th percentile to 70th myself personally, but you have to do whatever is real to you. But right now, we're in choppy waters. This isn't smooth sailing. That doesn't mean you can't reach your destination. All right? That does not mean you can't reach your destination. You just have to pay attention. And if you want help with any of this, how to drop plans, how to raise your fees, and do it smoothly so that you end up at the other end of this very successful, we are more than happy to help. Just give us a call here at MGE at 800-640-1140, or you can find us online at www.mgeonline.com. Guys, have a great week and do well.